This is not a headline meant to shock anyone. It is a signal meant to warn them. Because when a central bank moves in urgency, when time, not policy, becomes the constraint, it means something is already broken beneath the surface. Markets are still open. Prices are still printing. Banks are still operating. But the clock has started. And in the next 48 hours, decisions will be made quietly that will decide who absorbs the losses and who is protected from them. Stay with this analysis, because by the end, it may become clear this was never about silver at all, and that is where the real danger begins. Welcome to Boring Currency Ledger. If someone has lived long enough to remember a time when money felt solid, when savings were built slowly and carefully, then this channel was built for them. Subscribe, not for noise or excitement, but to stay aware when the system speaks softly, just before it changes loudly. And before continuing, tell us in the comments, from where in the world are you watching today? The story begins with urgency, but not panic. It begins with a signal. When reports emerged of an urgent meeting at the Federal Reserve, experienced observers did not ask whether something was wrong. They asked what had already failed. Emergency meetings at this level are not called because of headlines or market noise. They are called when internal systems no longer align with reality. At the center of this moment stood Jerome Powell. He was not acting as a single powerful figure, but as the visible face of an institution under pressure. The phrase 48 hours mattered more than any policy tool. In modern financial systems, time is the final resource. When time becomes scarce, control is already weakening. What triggered this urgency was not a stock market crash or a public banking failure. It was a commodity price. Silver had crossed the $200 level. To many people, this sounded like a story about metals. To institutions, it signaled something deeper. Silver is not just an investment. It is an industrial material, a monetary asset, and a settlement tool used across global supply chains. Its price connects manufacturing, finance, and trust in contracts. When silver moves sharply and unexpectedly, it often signals stress beneath the surface. The issue was not the number itself. It was how the move happened. For business leaders and entrepreneurs, this moment mattered because of information timing. Public discussion always lags reality. Emergency meetings are not held to debate possibilities. They are held to respond to conditions that already exist. By the time risks are discussed openly, positioning has already changed. The urgency also revealed a deeper structural issue. For years, markets assumed contracts could always be rolled or settled without friction. This allowed leverage to grow far beyond physical supply. In calm periods, this structure appeared efficient. Under stress, it became fragile. Silver exposed that fragility. It forced institutions to confront a simple question. What happens when too many claims exist on too little real supply? This question cannot be solved with money alone. It requires repricing, restructuring, or failure. That is why the clock mattered. Each hour without resolution increased the risk of spillover. Commodity markets are linked to banks through margin systems, to companies through supply contracts, and to currencies through trade flows. Stress moves quickly. This was not a moment for panic. It was a moment for awareness. The emergency meeting did not signal collapse. It signaled transition. It showed a system reaching the edge of its design limits. What followed would determine who adapted early and who reacted late. That understanding set the stage for everything that came next. To understand why silver mattered so much, one had to stop thinking of it as a metal and start seeing it as a diagnostic tool. In modern finance, silver occupies a rare position. It is both an industrial material and a financial asset. It is used in electronics, energy systems, medical equipment, and defense technology. At the same time, it is traded, hedged, and leveraged through futures, options, and exchange-traded products. This dual role makes silver unusually sensitive to stress. When something breaks in the system, silver often reacts before larger, more visible markets do. For years, the financial architecture treated silver primarily as a paper instrument. Prices were discovered through contracts, not through delivery. Most participants never expected to receive metal. They expected cash settlement, rolling positions, and stable liquidity. This structure worked as long as physical demand stayed quiet and trust in settlement remained intact. That condition no longer held. The stress did not begin with investors. It began with users. Industrial buyers, state entities, and manufacturers started demanding physical supply. They were not interested in exposure or price tracking. They needed metal in hand, on schedule. This shift changed everything. When physical demand rises quietly, paper markets can absorb it. When physical demand rises suddenly and refuses substitution, paper markets lose their anchor. Prices, one of the most important signals, came from outside the traditional Western system. On venues like the Shanghai Gold Exchange, silver trades are tied closely to delivery. Contracts are structured around real movement of metal, not just financial exposure. When prices there diverged sharply from Western paper prices, it revealed a split in price discovery. This split mattered more than any headline. It meant there were now two prices for the same asset. One was based on promises. The other was based on possession. History shows that when such splits persist, the promise price eventually adjusts to reality, not the other way around. The deeper issue was leverage. Over time, financial markets had layered claims on top of silver far beyond available supply. Each contract assumed that most participants would never ask for delivery. This assumption allowed efficiency, liquidity, and profit. It also created vulnerability. When even a small percentage of participants changed behavior, the structure became unstable. This is why silver acted like a fracture point. Unlike currencies, it cannot be created. Unlike equities, it cannot issue more shares. Unlike bonds, it cannot be refinanced. Its supply responds slowly to price, and its demand can surge suddenly. These characteristics make it unforgiving when systems are overextended. For policymakers, this created a problem with no clean solution. They could address liquidity stress, but liquidity did not create silver. They could calm markets, but calm did not move metal. They could signal confidence, but confidence does not fulfill delivery obligations. Every traditional response tool worked on perception, not constraint. For business leaders, this distinction was critical. Many companies were exposed without realizing it. They held silver indirectly through hedges, suppliers, or financial products. Their risk models assumed orderly markets and smooth settlement. Those models rarely accounted for a breakdown between paper pricing and physical availability. When that breakdown begins, contracts must be renegotiated. Costs rise unexpectedly, deliveries are delayed, working capital assumptions fail. These are not abstract risks. Silver derivatives were not isolated instruments. They were linked to interest rates, currencies, and credit through complex hedging structures. When silver prices moved violently in physical terms, these linkages tightened. Margin requirements rose. Collateral demands increased. Institutions that appeared stable under normal conditions faced sudden liquidity strain. This is how commodity stress becomes financial stress. It does not announce itself with a single failure. It spreads quietly through balance sheets, clearing systems, and funding markets. By the time the effects are visible to the public, positioning has already shifted. The uniqueness of this moment lay in timing. The silver stress emerged in an environment already burdened by high debt, geopolitical fragmentation, and fragile trust. Systems that once relied on global coordination now operated in a more competitive, less cooperative world. In such an environment, assumptions break faster and repairs take longer. This is why experienced observers did not ask whether silver would come down. They asked what else would reprice. Silver was not the destination. It was the messenger. It revealed that financial architecture built on smooth rollover and infinite trust struggles when confronted with physical reality. It showed that markets can function technically while failing structurally. And it reminded decision makers that when real assets and paper claims diverge, strategy must adjust quickly. The fracture had appeared. The question now was how policymakers would respond and who would bear the cost of adjustment. By the time the third phase of the story began, the issue was no longer silver. The issue was authority. Inside the policy system, moments like this are described as constraint events. They occur when institutions still have power on paper, but far fewer options in reality. This was the position facing the Federal Reserve as the emergency window narrowed. From the outside, central banks appear unlimited. They can create money, support markets, and calm investors with words alone. From the inside, however, they operate within strict boundaries. They depend on confidence, legal alignment, and global cooperation. When one of those pillars weakens, policy tools lose effectiveness. This was one of those moments. Jerome Powell was not choosing between good and bad outcomes. He was choosing between different forms of damage. Each available path carried costs, not just financially, but institutionally. The first option was direct intervention. This would involve providing liquidity to institutions under stress, allowing them to meet obligations and stabilize markets. On the surface, this seemed familiar. Similar actions had been taken in past crises. The problem: this stress did not originate in credit markets. It originated in a mismatch between physical supply and financial claims. Liquidity could ease pressure temporarily, but it could not resolve the underlying shortage. Supporting institutions without addressing the cause risked signaling that paper claims would always be protected, even when detached from reality. That signal carries long-term consequences. The second option was regulatory containment. Trading could be paused, settlement rules could be adjusted, price limits could be imposed. These tools exist for extreme situations. They are designed to slow panic and buy time. But time was already the scarce resource. Halting markets would not restore confidence. It would raise questions. If prices were accurate, why stop trading? If contracts were sound, why change rules? Such actions tend to confirm suspicion rather than reduce it. International participants, especially those operating in delivery-based markets, the global financial system no longer moves as one. Nations now prioritize domestic stability, strategic resources, and economic sovereignty. In such an environment, coordination is slower and less reliable. What benefits one system may harm another. This left policymakers in a trap. They could act aggressively and risk credibility. They could act cautiously and risk contagion. Or they could delay and hope conditions improved. Delay, however, is itself a decision. Markets rarely reward hesitation during structural stress. For business leaders, this phase of the story was critical to understand. Policy responses shape incentives. They determine which behaviors are punished and which are protected. When interventions shield excessive risk-taking, future risk grows. When interventions allow disorderly failure, short-term pain increases, but long-term discipline may return. Entrepreneurs watching closely were not looking for reassurance. They were looking for signals. Would contracts be honored as written? Would prices reflect scarcity? Would losses be socialized or absorbed? These questions influence capital allocation. Companies delay investment when rules appear unstable. They accelerate procurement when supply is threatened. They reassess counterparties when settlement risk rises. None of these decisions require panic. They require clarity. The challenge for policymakers was that clarity itself could be destabilizing. Admitting limits undermines authority. Pretending limits do not exist. The decisions made within those 48 hours would not only address silver-related stress, they would redefine how markets interpret promises, contracts, and official backstops. They would influence behavior long after headlines faded. For young entrepreneurs and aspiring business leaders, this was a lesson in power and limits. Institutions appear strongest when conditions are calm. Their true shape is revealed under strain. Authority is not measured by intention, but by outcomes, and outcomes are constrained by reality, not rhetoric. As the policy window narrowed, the system approached a turning point. Whatever choice emerged would redistribute risk. Some participants would be protected, others would be exposed. The structure would adjust. The only certainty was that neutrality was no longer possible. In the final phase of the story, attention would shift away from policymakers and toward those who must operate within the new conditions. The question would no longer be what the system decided, but how individuals and businesses adapted to the consequences. By the time the final phase of the story unfolded, the focus moved away from policymakers and markets and toward decision makers inside businesses. This was the stage where theory met consequence. What mattered now was not what authorities intended, but how conditions were changing on the ground. For companies, the first impact appeared in pricing assumptions. Many businesses relied on stable input costs and predictable contracts. They budgeted based on market prices that assumed smooth settlement and reliable supply. When silver and related commodities experienced stress, those assumptions weakened. Suppliers began revising terms. Delivery timelines stretched. Prices quoted on screens no longer matched prices demanded in real transactions. This forced managers to confront a difficult reality. Risk was no longer abstract. It was operational. Procurement teams faced a new challenge. They had to decide whether to secure supply at higher costs or risk interruption. Waiting for prices to normalize became a gamble rather than a strategy. In systems under stress, delay often increases exposure. At the same time, financial exposure came under review. Many firms discovered indirect risk through instruments they barely monitored. Hedges tied to commodity indexes, exchange-traded products, or structured contracts behaved differently when physical constraints appeared. Positions designed to reduce volatility began amplifying it. Accounting values diverged from replacement costs. This created tension between financial statements and operational needs. Executives had to decide which numbers mattered more, the reported price or the real cost of doing business. In such moments, companies that focus only on reported performance often miss deeper threats. Another area of concern was counterparty risk. Banks, brokers, and intermediaries play a central role in modern commerce. Businesses assume these entities will perform as expected. During structural stress, that assumption must be tested. Rising margin calls and liquidity pressure can change behavior quickly. Credit lines tighten, terms change, access becomes selective. Wise leaders responded by asking simple questions. Who holds the risk? Who settles in cash? Who depends on continuous market functioning? These questions revealed vulnerabilities that normal conditions concealed. Liquidity also took on a new meaning. Cash remained important, but access mattered more than balance. Companies learned that having funds was not the same as being able to move them freely. Systems under pressure prioritized certain flows over others. Flexibility became a strategic asset. For entrepreneurs, this environment rewarded realism. Growth plans built on cheap capital and stable inputs required adjustment. Expansion slowed. Resilience gained value. Businesses with diversified suppliers, lower leverage, and tangible assets gained relative strength. Those optimized purely for efficiency faced harder choices. History shows that periods of structural repricing reshape competitive landscapes. Firms that survive do not always do so because they are largest or fastest. They survive because they adapt early. They recognize signals before outcomes become obvious. They accept near-term discomfort to preserve long-term viability. This moment followed that pattern. Silver's role in the story was symbolic but instructive. It highlighted how quickly trust can shift when physical reality contradicts paper assumptions. It reminded businesses that contracts are only as strong as the systems that enforce them, and it showed that price stability can coexist briefly with structural instability. For decision makers under 40, this was not just a market event, it was a lesson. They were witnessing how modern systems respond when stretched. They were seeing how authority behaves under constraint. And they were learning that resilience is built before crisis, not during it. The most effective responses shared common traits. Leaders simplified exposure. They reduced dependence on complex instruments they did not fully control. They communicated clearly with suppliers and customers. They prioritized continuity over optimization. They treated uncertainty as a condition to manage, not a problem to eliminate. Importantly, they avoided panic. Structural stress does not reward emotion. It rewards preparation and clarity. Companies that acted decisively but calmly positioned themselves to endure adjustment. Those that waited for reassurance often found that reassurance arrived too late. As the final hours of the policy window approached, one truth became clear. The system would continue, but it would not remain unchanged. Prices would adjust, rules would evolve, some assumptions would not survive. For businesses and entrepreneurs, the task was not to predict every outcome. It was to recognize the shift and align accordingly. The story that began with an emergency meeting ended with a broader realization. Stability is not the absence of movement. It is the ability to adapt when movement becomes unavoidable. Those who understood this did not need to fear the change. They prepared for it.